Thank you very much, Bill. And I've been to the UK many times. I never got up to Cambridge. It's a real treat to be here. It's such a beautiful campus. Certainly hope I have opportunities to come here again. And I thank all the sponsors and organizers for having us on. There's been a lot of theory, and I appreciate theory, but I'm gonna try to give you some concrete perspectives on how I think this crisis developed, who might be responsible, how we can do better, and certainly in that is the efficient market hypothesis to blame for it or not. I think I'd like to make a couple comments. Ken Rogoff yesterday, and there's been some comments today about the great moderation, and I think that is linked to what we saw. What is the great moderation? Well, economists looking at the business cycles, fluctuations in GDP and other real variables, notice that since the 1982 recession, that the fluctuations in real variables, the severity of cycles, had been noticeably damped. Not just in the United States, but in most of the other developed countries in the world. Record periods of time between recessions, standard deviations that were about 1/2 on quarter-to-quarter changes in real GDP. Now, there's been, economists try to explain that situation. There were a lot of explanations offered. The developed countries had become more service-oriented. Service-oriented industries do not fluctuate as much. There's more information. The inventory cycle had been damped, just-in-time inventories. The computers that firms use in order to stock their stores are much better, much less overproduction. And yes, even policy had been better. We understand better how to run policy, how to look at the right variables, and all those occurred. Now, I think many are true, but take a look at what the reaction should be in the financial markets. If you actually believe that the real economy is more stable, for whatever reason, you're going to take on more leverage. That's rational. Risk premiums are going to go down. That's rational. And that is what happened. Now, what is interesting is that it happened too much. And the regulators allowed it to happen too much. But there was a real economic reason for increased leverage and for the reduction in those risk premiums. By the way, that is not dissimilar to what happened in the 1920s. If you take a look at fluctuations in GDP, of course, we didn't have quarterly GDP back then. We had industrial production. It was damped. Many actually cited the establishment of the Federal Reserve, the central bank, as a reason for that damping. Leverage went up. Risk premiums went down. Just as an interesting analogy is the leverage went up, and then, of course, we didn't have a separation from banking from equities. There was a lot of lending. We all know margin was all the way down to 10%. You could loan 90%. Banks loan 90%. Speculation against the market. And bang, when there is a bump, when you're at that level of leverage, it's going to be much more severe. Actually, what happened, I think, in this crisis wasn't in the equity markets. It's curious. There was more wealth destroyed when the tech bubble burst from 2000 to 2002 than in the loss of the subprime mortgages. And yet, first of all, we didn't have conferences, is efficient markets wrong then? Oh, there were a few, but not many. It's interesting that now we do when we saw a worse bubble in 2000. What happened after the 2000 bubble? A minor recession. And by the way, which was combined with the 9/11 terrorist attacks to sort of push us in, and we got out right away. There was how much? I think something like $10 trillion of stock market wealth from top to bottom, more than the entire amount of subprime mortgages in existence. Why didn't that crash produce the same crisis that we have today? Let me tell you a reason, I believe. In this crisis, the financial institutions themselves levered up on these risky assets. In 2000, they didn't. They sold them out. Everyone had it. It was distributed. The wealth went down. They were not leveraged in them. What happened, unfortunately, some people say the crisis was caused, Wall Street was selling bad stuff, and they knew it. That was the problem. They didn't know it. If they knew it, they wouldn't have levered up on it. And it was the excess leverage that they moved into those markets, real estate related, that once those markets started going down, they were gone. They were lost. Now, what went wrong? There was a tremendous misestimation of the risk in these real estate-related assets. Not so much the level, but the risk. Now, let me talk a little bit about that, because that relates to efficient market theory. There were very good reasons why real estate prices rose from 2000, 2002, all the way to 2005 and 6. Maybe not as much as they did rise, but certainly there were fundamental factors at work. A major one was the decline in real interest rates to record low levels. Long-term real interest rates. Remember, in the United States, when TIPS were first floated in 1997, 3.5% to 4%. They were already down to 1.5%. Nominal rates were even lower, and of course that makes the ease of financing and cash flows even greater. So the lower real interest rates were certainly one of the reasons. What else was going on? They pointed out the securitization of real estate-related assets. Now, that did them in eventually, but markets for real estate-related assets were becoming more efficient. You know, securitization started back in 1980. It worked very well. It worked very well with the conformable markets, Fannie and Freddie conformable loans. It's when they got into the subprime loans and the Alt-A loans, combined with a tremendous upward surge of those real estate prices. Now, other reasons, baby boomers buying second homes, vacation homes at high levels. Now, I'm not saying that real estate prices should have gone up as much as they did, but what I'm trying to relate is that I heard good reasons why they went up. I had good enough reasons that I, who like to look at the markets, were not going to go out there and short the home builders. I was not going to short the financial institutions that were making money on that. I've talked to a number of my colleagues, many of which do a lot in the markets, and told me, Jeremy, it was so clear that real estate prices were so high. Everyone knew they were way so high. So I said, well, Tom, let's say, did you take a short position in the builders, in the financial institutions? No, I didn't. You know, in fact, one admitted to me, he said, when I finally looked at my portfolio, after telling everyone I thought real estate was overpriced, I found out I held a lot of those firms. what I'm saying is, what does efficient market say? It says, doesn't mean that the market prices are always right. No, most of the time, market prices are wrong. If we really had complete knowledge, they wouldn't be where they are. But what we're saying is there are intelligent reasons why they have moved that you cannot completely dismiss, or you do at your own risk. What I find is the biggest time that markets have their problems are when there has been some fundamental change and they're trying to assess a new level and having great difficulty. They often go too far in that direction. Let me mention, we saw real estate prices go all the way up. They haven't come back all the way down. I look at the Case-Shiller indices, Bob Shiller, my best friend, and you know what? They started going halfway down and stabilized, actually beginning to go up a little bit. Now, there are a lot of economists out there that say, oh, it's just a matter of time, this is just a pause, it's going to go all the way back down. But there's others that say, you know what? It's not going to go all the way back down. It overshot, went too high, it's come back part of the way, but those low real interest rates, securitization, high demand for real estate will keep them higher than they were before. We haven't heard the last chapter, maybe wrong, but when we say, oh, it's a bubble, everyone knew, everyone did not know. Very few people knew with confidence what the new level of real estate prices actually should be. Now, after saying that, I'm not going to excuse who I think are people, regulators and others, that are responsible for what happened. They should have said, and I'm going to put my finger on the regulator, Alan Greenspan. He could have said, you know what? Real estate prices might be right. They've gone up a lot. I'm hearing good reasons. I'm not going to try to second guess the level of those prices. But you know what? I have to prepare the markets for if they're wrong. There is risk here. That story may not be right. That was his failure. Not to say, oh, I knew they were all too high, was to say, I'm not sure they're too high. But it's my job to see whether there would be tremendous damage to our financial system and our economy if they're not right. If they're not right. And that was his big failure. That was the Fed's big failure. And when Greenspan in December went before Congressional Committee, saying, I thought that the financial institutions had all protected themselves against these declines. I was shocked that they did not. And by the way, the blame on the private side goes to the CEOs of all the investment banks. You know what they relied on? Let me tell you a big fundamental. The risk models. Standard & Poor's, Fitch's, Moody's, their risk models were all wrong. And let me tell you how they're wrong. Very interesting, because I talked to a few of the people there. And this is a summary. This isn't verbatim. We looked at past series of real estate prices. We even looked at Case-Shiller and all of them. On a national diversified basis, the maximum decline that we saw year to year on a nominal basis was 2 to 2.5%. All right. So we now have a nationally diversified first tranche of first mortgages, the top 80% or whatever. We then estimate what's the probability that they'll go bad. Well, the worst was 2.5 or 3, so it has to go 3 or 4 standard deviations before it eats into the principal. That's what we saw. That was the models we were using. And that's why we say these were AAA. You know, before they used to be regional, and there the standard deviation was much higher. On a national basis, all these small bubbles, one way or the other, got evened out. But on a national basis, look at the data. Look at the data. Now, there was a case. You know, if you looked at the data that way and had your mathematical models that way, you were right. If you stood back and plotted the path of real estate prices, you would have seen, yes, they never went down more than this, but in the last 5, 8 years, they've gone up 60, 70, 80, 90%. We have to assess risk from a different perspective. How far are you away from a trend, even allowing for some fundamental factors to change? You know, there was a great statistician by the name of John Tukey, and I think I'm paraphrasing because one person told me about his view on data, and it's very much my view on data. He has his students analyze time series. And what was the first thing he told his students to do? And this is what our students don't do. It's too easy. And by the way, this is what happened. It's too easy to dump the data into a computer. Oh, I got the data, put it in the computer, read out the standard errors. You know, that's it. I read out the standard errors. You read out the standard errors, maximum declines and all that. You take those, you won't find it. John Tukey said, you know what you should do before you do any statistical test? Plot the data and look at it and think about it. And try to understand as much as you can from the time path before you run your first regression. And unfortunately, that just wasn't done. These guys dumped them into the computers. They looked out maximum risks. They were rated as a result that way. You know, it's interesting. We talk about the markets getting it wrong. The markets were actually very close to getting it right. These AAA and AA tranches were not trading the way AA and AAA securities, either in the corporate or government and sovereign sector, were trading. This is ironically what led AIG to decide, oh, just a minute here. If I write, the premium I get through writing an insurance on a corporate AAA is X, I can get 2X or 3X by doing them on these AAA mortgages. The market was leery itself that these were worth as much as the rating agencies put it on. But AIG did its models. They say, all right, our models show what's the probability of AAA has ever gone bad in the last 50, 60 years. Write 100 billion of these. Write 200 billion of these. The market was trying to tell AIG something. AIG wouldn't listen. It wrote them all, and all of a sudden, the real estate prices went down, and these AAAs, got smashed into junk bonds in a matter of a year or more. So in a way, markets were telling some of these firms something, and they refused to listen. The CEOs of the firms just abdicated their responsibility for monitoring risk to their tech guys. You guys have the computer, you're telling me about this risk, and then, of course, fall back on the comfort that Standard & Poor's and Moody's were rating on these AAAs. Hey, guys, these are good things. I can borrow. Remember, term structure was very steep. Let's borrow short-term at 0.50 basis points. We're going to buy these subprime mortgages or Alt-A mortgages, huge spreads. That's basically what happened. They got suckered. Goldman Sachs began to get smart and saying, just a minute here, I don't like the way some of their traders who look every day at the market and market every day to the market, and we're saying, just a minute here, these bonds are not trading right. Let's look into what is going on here. And then convince the CEO and others to, hey, let's reverse the position. As I said, the upstairs reversed the downstairs positions. Goldman was going into it and then smart enough just in the nick of time to reverse those positions going upstairs. But that was what was really going on in the market. And then going back to Greenspan not recognizing that the firms even had these risks. He thought they were laying off all these risks, which they were not. That's a regulatory failure of the first degree. Did that really have anything to do with the efficient markets? Some say, Greenspan had blind faith in the efficient markets, so as a result, he just didn't question the prices. He could have, as I said, these real estate prices, they may be right, but our firm's taking too much risk. He never monitored that. And that's what really caused this financial crisis. Again, the absolute decline in wealth of the securities related was less than what happened in the tech bubble and the bear market that followed the tech bubble. But in this crisis, they were concentrated in the financial firms. And then suddenly, levered and concentrated, all the counterparties disappeared, and well, we know Lehman and then AIG was saved, and then on and on. And then there was panic everywhere in the world about all the counterparties, who is safe, who isn't, and that anxiety rose up. All right, I want to end with some thoughts. It's exciting to be here, where Keynes did his work, and I got my PhD at MIT under Samuelson. Really appreciated the Keynesian point of view. I taught 4 years with Milton Friedman. He was on the video at the University of Chicago last 4 years before he retired. It was to understand their standpoint. We're speaking a lot here about the failure of economics. I tend to disagree. Yes, there was a failure of regulation, and yes, we could have done much better in this. Yes, I absolutely grant that. But in terms of economic theory helping the economy, I think we're witnessing a huge success. I really think the lessons that both Keynes and Friedman, they were often in opposing camps, but both of them impressed on us over the course of the years are the measures that the governments and central banks do. I give the Fed a D up to the crisis. I'm giving them an A after the crisis. They made sure the banking system didn't collapse. They made sure to pump in enough high-powered money, monetary base and reserves, to keep the deposit levels as they should be, which is what Milton Friedman had always said. Yes, we're using fiscal stimulus. This is what Keynes said. Yes, we cut taxes, even though the deficit would get higher. Now, yes, the final chapter is not in, but, I look at economic data all the time. I'm feeling extraordinarily encouraged by what I see. I think the recession is certainly over in the U.S. I actually think the recovery is going to be better than people fear. It's going to be faster. Emerging markets have come back dramatically, and not just China. Not just China. Even if you take emerging markets, excluding China, 95% of the loss of GDP has been recovered. We have dodged the bullet that we did not dodge 70 years ago, when the same crisis started and the authorities did not know what to do, either on the fiscal side or the monetary side. And I think what we're seeing here is a success story, a failure at the regulation and getting at the over-leverage that took place. But once it happened, a huge success story on what macroeconomic theory, traditional. I'm not going into real business cycle models and all those, because I don't think they really reflected anything of what was going on. But the models that we were reared on, I think, have shown to be correct at stopping the crisis from spreading into a huge calamity. So I know I'm ending the morning session, but I think we have a lot to be thankful for, and I think we economists have something to be proud of, despite the failures that took place and led to the crisis that we're in. Let me just have one thing, and I talked about the great moderation. If you talk to engineers today, there's no question that automobiles are safer today than they were 40 years ago. In terms of airbags and anti-lock brakes, all sorts of things. They are safer. Deaths have gone down. One expert told me that we can drive safely today at 70 to 75 miles an hour, as 40 years ago we could at 60. But it doesn't mean we can drive safely at 100 miles an hour and 120. And that's what we tried to do. The leverage that was built up, the risk down so much, like, hey, we'll never have a recession. And then when you're going 100 miles an hour, you don't have to hit that bad a bump before you flip over. Had leverage not been overtaken in these firms and kept normal, I think we would have been in a minor recession now. But at the speeds we were going, there was almost no way to actually avoid what happened. But those are my comments. Thank you very much.